Good morning, everyone. Just gonna wait a minute or here so to see anybody else who trickles in. Good morning, Clayton, Daniel, Glenn, Jack, James, Keith, Kirkland, Richard, Sean, and Susan. Okay, let's go ahead and get right into it. Good morning, everybody. The topic for today's webinar, as I had mentioned, as you saw on the sign-in sheet, is all about for brand new franchisees. What are some tips and tricks to find success? Pitfalls to ultimately avoid. We're pulling from about 4 years of experience and working with over 1,000 startups and over 50 brands. We've just learned, over and over again, we keep seeing the same things. How do I pay myself, and how do I stay compliant, and what's required for me when it comes to like accounting, and how do I make the most of my relationship with the franchisor? So we wanted to, kind of condense all this into a 1-hour webinar and share. Please, as we're going throughout and thinking about your own experience, if you have any questions, we would love to hear kind of the situations that you may have run into or running into. We also want these webinars to be driven by what you guys are interested in and seeing and learning from a CPA that specializes in this area. So again, as we're going throughout, if anything kind of comes to mind, write it down and make sure to ask that question here at the end of the webinar. So let's get right into it. Okay. So finding success with your new franchise. If you did just go ahead and purchase, I know that the attendants today are all in different phases of your journey here, but in any event, if you decided to buy a franchise, then congratulations. That is really exciting and a new a phase in your life, especially if you are coming from like a W-2 job and this is your first take at business ownership. As you've already seen, there's a lot of information. It's like drinking from a water hose, and a lot of challenges, but ultimately the rewards are there. So stick with it, and let's get into it. And by the way, I just want to mention every single franchise is different. The brands are different. The industries are different. So there might be specific strategies that make more sense to being successful with a restaurant versus, like a teriyaki madness as opposed to a home service like a budget blinds or a grounds guys, restorations like your Puro Clean, your Restoration One. What we're going to be going over today is more of a general, general strategies that are going to be effective pretty much across the board. And then again, if you have any industry specific questions, we're happy to help you and to answer those questions. So the first tip is listen to your franchisor, and this might seem like a no-brainer, like duh, we bought a franchise to get guided by the franchisor, right? Well, what happens a lot of times, especially when you get into operating the business, is you can get lost and busy and start to stray away or pull away from the support of the franchisor. Try your best not to make that mistake, because you're paying them for a reason at the end of the day, right? You paid an initial fee. You're paying a royalty on every single sale that you make, and you're paying an advertise. A lot of the brands require some kind of an advertising fund that you pay into. and you're doing all that to get support. So definitely keep a good relationship open with your coach or your consultant or your connection inside the franchise, and reach out whenever you need help. Hey, I'm not sure if my marketing is going well. Do you have any tips? Hey, I'm getting the hang of operating, but I definitely could use some guidance here, and they're there to help you. This is a big one, and something that we come across a lot as a CPA firm. So when you start up, all of a sudden you're going from being a W-2 employee to owning a business, and expenses are coming in fast. And there's an incentive you feel to not pay for this, not pay for that. A lot of times we connect with startups who don't want to pay for accounting fees, or maybe I can save $100 a month here or there if I use a different service provider. And so what ultimately will happen is the franchisee, the startup, will spend months and sometimes up to a year without accounting because they want to avoid that fee. And this is a huge mistake, because you have no idea how your business is doing if you don't have your accounting in order. And if you can do it yourself, if you have that experience, like if you are an accountant, or if you if you've owned a business before and you're used to running your own books, that's fine. You don't have to use us, of course. You don't have to even use a third party, but you have to have accounting for your business. This is a non-negotiable item that, unfortunately, it's kind of like saying, I'm never going to go to the doctor to get a checkup. Okay, great. But eventually you're going to go, and it's going to hurt, and it's going to be really expensive. So accounting is definitely a preventative measure to make sure to keep your finger on the pulse of your business, to know if you're doing well or not. And if you're not, then that's an indicator to you to figure out why and to correct course. So your accounting is vital. This is a really common question that we get. I would say 90+%. Of course, they want you want to know, hey, I got a franchise. How do I pay myself? When you're a W-2 employee, you just kind of, you fill out a direct deposit form at the beginning of the thing. And there's like a magical money fairy that just comes and drops money into your bank account every 2 weeks or whatever the terms were. Not the case when you own a business. And the way that you pay yourself, it really depends on how you structured the business. Now, we're not going to get into which structure is better or worse. We're actually going to go over that in our following webinar in April, where we're going to go over tax planning. We strategically plan that one for the day after the 15th, which is your typical taxes due day. By the way, I'm sure a lot of you've seen, but they extended the due date to the middle of May now. I think it's the 17th. So that's great. But in the following webinar, we're going to be going over structure types and what is more advantageous from a tax standpoint. For today, though, we're just going to go over, depending on what you have set your business up with, how are you going to pay yourself? So the common structures that we see are the LLC as a single member, especially if you're starting up and you're the only owner of the business. This is a common structure, and some people will opt to be taxed as an S Corp, which is an option that you have. If you're an LLC and you're a single member, you can pay yourself whichever way you choose. If you want to take draws, and that's essentially just you write yourself a check, your person a check from the business to draw the money out of your business account to your personal account, that's fine. Or if you want to get on a salary if you want to work with like an ADP or a Gusto or two great options. You can be on a payroll, and then your pay kind of works like it did when you were a W-2 employee. So you're once again going to receive the money fairy is going to come, except now it's you. You're dropping yourself checks, which is pretty cool. So the LLC as a single member is really the most flexible structure when it comes to paying yourself. Very, very important. You might have heard, and we're going to go over the C Corp structure as well, because that's somewhat common as well for franchisees. You may have heard that if you're a C Corp, you will get taxed twice. The earnings of the C Corp are taxed at the corporate rate, which is currently 21%, potentially going to go up as we spoke about in our February webinar. And then when you pull money out of a C Corp, it's taxed again. So that's where the double tax will come from. So a lot of people have a misunderstanding with an LLC that, oh, I can pull money out as much as I want and it's not taxed. But wait a minute, if you have no equity in your LLC, so if you started up and you've essentially lost money, or if you've pulled out so much money that your equity drops to zero, and then you draw beyond that because there is cash in the business, you're actually the IRS considers that additional taxable income. Very, very important to not draw beyond your equity a position. Now, when you're starting out, sometimes it's impossible to avoid that, and that's fine, especially at the beginning, because you start up, you get your SBA loan or your ROBS. Well, you can't do an LLC with ROBS, but you get your SBA loan, or if you contributed the funds, you're incurring a lot of expenses. You haven't made any sales yet, so your equity is going to be at or near zero, and you have to live, so you'll pull money out. Just if your equity is at or near zero, be careful. Try not to pull out more than you actually need. That's a really good idea. Now the S Corp, if you're an LLC as an S Corp, you have to pay yourself a salary. It's required. Now you may have heard that the S Corp, it's advantageous from a tax standpoint, and there is a lot about an S Corp that can help you. Just know that if you are an S Corp, you still have to pay yourself a salary, and the lower the salary is, the better off you are when it comes to taxes. So you want to get that as low as you can. But you can't pay yourself $1 a year to do a full-time job running a business. The IRS says you have to pay yourself a reasonable compensation. So yes, that's really a broad, a gray area. And we actually help our clients to determine what would be a reasonable compensation. It depends on what you're doing. It depends on the industry. It depends on the state as well. Like obviously a salary in California should be quite a bit more than perhaps in Texas or in like Alabama or Florida. So it really depends on where you are as well. Now, as I mentioned, we're going to go over the C Corp, and we'll especially see the C Corp for our clients out there, or for anybody out there who funded through a ROBS. You know that you have to establish a C Corp. So like an S Corp, you have to pay yourself a salary in a C Corp if you're working in the business, which is almost always the case when you're a startup franchisee. Alternatively, if you had a big C Corp and you're like just a stockholder, but you don't actually operate, then you don't have to get a salary. But this is specific to you guys, to franchisees. Almost always you're going to be operating and working in the business. And As I mentioned, for a C Corp, the draws, which are called dividends, are taxable. So be careful, don't get too excited about pulling money out of a C Corp, as every time you do, you're adding to your tax bill at the end of the year. Again, in our previous webinars, as we went over, the current administration is looking to increase the taxes across the board. So yeah, just be careful with that. The next thing, talent. So this is another common thing that we run into. So depending on the brand that you bought into, a lot of times you're going to need employees. You're not going to be able to do all of the labor on your own. So especially if you're like a grounds guys or a conserva, if you're doing that kind of the lawn care stuff, if you're a budget blinds, sometimes they'll do all the work themselves, but eventually you want to get an installer. If you're a restoration, if you're a Puro Clean, if you're any of those, you're going to need employees, and many more. Of course, like a restaurant, you're going to need a bunch of employees. So you're going to need employees, and often what will happen is the new franchisee will wait to start to look for employees. There's so much going on, the paperwork you have to fill out, all the training you go to, and just there's a lot to learn. And then, okay, when all is said and done and the dust settles, now you sit down and start to look for employees, and you realize it's not that easy to find employees, and it's really harder than that to find good employees. So we recommend that this isn't something that you should wait on. You should immediately begin to look. And you could always reach out to the franchisor with tips on how to find employees. We have clients that will look on ZipRecruiter is one, on Monster is another one, Craigslist, depending on what you're doing and the level of employee that you're looking for can be an option. And also sometimes these suppliers, so this is an interesting trick, but depending on who you're working with, you might be working with one or a couple suppliers for all of your materials, and they might know somebody either that worked for them that already kind of has inside information and experience in the industry that you're looking at, or they just might be able to help you out. So in any event, don't wait. You want to look for talent before you need it, not when you need it. Because if you look when you need it, it takes time. You have to interview, you have to, it has to make sense for them, it has to make sense for you. And you don't want to miss out on demand. So the longer you take to find talent, the longer it'll take you to actually to service your customers. And as you all know, and I know, we hate to wait. So if you're not going to be able to deliver the service that the customer is looking for, they're going to move on. So you want to have your employees in place. Marketing is one of the easiest things to immediately screw up when you buy a franchise. Now I'm just going to come out bluntly with it. You're going to spend a lot of money on marketing. If you think about your top expense lines, you've got rent, employees, marketing. So three of the big ones. Depending on what you're doing, materials, of course. But if you're not doing anything with materials or inventory, in any event, your advertising and marketing line is going to be really big. And what can happen, especially when you're starting up, you might see all the bells and whistles by some of the provided, the suggested sources, and you just come right out of the gate and start spending $3, $4, $5 grand a month on marketing. Come to find out a few months down the line, you're not really getting a benefit from that. And the reason is you have to be extremely strategic about how you market. For example, if you bought a territory or 2 or 3, and you've got a runway of $3, $4, $5 million potential customers, well, you don't want to just go out and market to them all immediately, especially at the beginning when you're not really established to serve them. It makes a lot more sense to apply your marketing to more of a localized area. So for example, you might want to start in the area that you're immediately in, especially if you think about the logistics of things. So let's say you are a budget blinds, and you have a 3 million population territory. The city that you're currently in might have a 500,000 in population, or 300,000 that you can immediately go to and serve. You get there a lot quicker. Your employees would get there a lot quicker, especially if the employees you hire are near you. And then as you spend less at first, and you really build a name for yourself in the localized area, and then you have word of mouth, focusing on doing a great job for the customers that you first serve. So you'll expand from there, and then as you get a stronghold in the area immediately surrounding you, then you can expand from there, and you can expand your marketing from there. Of course, there are caveats with marketing. I'll go out right and say I'm a CPA. I'm not a marketer. So there's a lot more of a technical analysis to be had when you look at marketing. So depending on how quickly you want to grow, the brand or the industry makes a really big difference as well. But in any event, your marketing strategy is key to your success, no matter what you're doing. And now, especially in 2021, there are so many ways to market your business. I mean, eventually there will be a hologram in the corner of your room that will let you know that there's 15% off baby wipes or something. Who knows really where this is going. But you've got Facebook, TikTok, LinkedIn, your website, mailers, networking, pay-per-click, and then some or none of these methods may be your best bet. It really depends, again, on where you are and what you're doing. So be flexible when it comes to marketing, especially if you're new to it and this is your first run at owning a business. And essentially, you want to try different methods and measure. Coming back to measurement being super important to your success. You want to know how each of the methods are working for you. Where are you getting the majority of your customers? And double down on that, and don't spend where you're not, getting a return. Okay, Jason, my business partner, is going to take it from here.
Hey, good morning, everyone. Thanks for being on our webinar. I'm going to take over from here, just as John said. So let's talk about your compliance requirements. They are going to vary from state to state, county to county, and local to local. And the compliance piece also depends on your industry and brand. So before you open your doors, and this is what we do with our clients that are startups, and we help them navigate through funding process and opening their business, we like to determine, we do like a basic search, and that is to determine, based on the specific brand you have, based on the state, the county, and the local requirements, what are the things that you're going to need to open. And then we dive into the territory itself if needed, and we can determine in your territory, what are all the municipalities, what are the county requirements for the unincorporated parts of your territory. We can register you with the townships, towns, etc., as required, so that you can operate your business and be in compliance with those things. I'll just give you an example. If you are a painting franchise and you go to a incorporated municipality, you go inside their boundaries and you start work. If by chance a code enforcement guy is driving around, or code enforcement person is driving around, they could potentially put a stop work order on you because you are not adequately in compliance with the operational, rules of that specific incorporated municipality. So very important. to understand your operating environment so you can be in compliance with all the requirements from the state, the counties, and the local. All right, know how business taxes work. Again, this is much different. Just like John said previously, you're going from a W-2 employee where your taxes were withheld by your employer, or maybe you have come from another business and you've used a payroll service. That's just one small piece. Payroll taxes is one small piece, but understanding the tax environment you're going to be operating in is going to be crucial. I'll give you another example. We have a client we just brought on recently. His former CPA firm told him a particular product and service that he offers, which is a major percentage of his revenue, is subject to sales tax. So he was including this in his quotes to potential customers. He was losing deals based on the quote of sales tax that he was under the assumption he needed to apply to the specific quote. What we determined is that he does not need to worry about sales tax for that particular product and service. So what is the end result here? The end result is by not having an adequate understanding of his tax environment, he was overbidding essentially on jobs and losing jobs. So what did this end up costing him? It cost him around $15,000 to $20,000 in potential revenue. So again, always the importance of understanding your tax environment. You as the business owner, it isn't necessarily 100% your obligation to understand the tax environment. What we want our clients to do is have a basic understanding, have us work with them to meet those compliance requirements related to taxes so that they can focus on their business. Again, we're going deeper into this. This is the income tax side. So it really depends on the entity structure that you have. In general, when you start to become profitable, you will have to, you'll pay your taxes at the end of the year, and you'll usually get an estimated tax voucher with your tax return. But in this case, what we like to do with our clients is when it is deemed appropriate and they're profitable, we will measure every quarter what your estimated quarterlies will be so that you do not receive what's called a tax surprise at the end of the year. What is that? Well, if your actual tax due is a percentage more than what you remitted to the federal government, they're going to go ahead and penalize you, and that's the tax surprise. So we work with our clients to understand what that quarterly obligation is so that they do not get the tax surprise at the end. With that being said, depending on your entity structure also has implications for you. So if you're an LLC single member, as it says on the slide, you're a Schedule C. The government treats you as a disregarded entity. You're an LLC for legal purposes, single member for legal purposes. But the IRS says, we view you as a disregarded entity and we are going to tax you as a sole proprietor. In the case of a multi-member LLC, you're going to be a disregarded entity taxed as a partnership. If you make the conversion over to an S Corp, you could be a single member LLC taxed as an S Corp. You can be a multi-member LLC taxed as an S Corp, not a sole proprietor and not a partnership. Again, this is an election that has tax advantages, but it's about when you make the election that will provide you with the tax advantages. So for startups, our strategy typically is let's wait till you reach a certain level of profitability. We're proactive and we can understand trends in your business. So we can say, client, it makes sense for us to make this S Corp election. And if we determine it's in June, we can retroactively go back to the beginning of the year and make this election. So the tax advantages are there. It's just a matter of knowing when to essentially pull the trigger and make the election. A C Corp is an 1120. John alluded to this previously. You are subject to double taxation, both from the income on the C Corp and any dividends released to you. If you are currently a C Corp, based on what the potential change will be to the current administration's future tax policy, If you are a C Corp, or if you're making certain amount over $400,000, there's a lot of things you're going to need to take into consideration because it will have a major impact on your bottom line, your profitability, and the future growth of your business. Of course, there's the rollover for business startups, and it's the 550 for the retirement plan, which is the 401k that owns a percentage of the C Corp shares. All right, so we've got the measuring success part of the presentation. You're never going to be able to grow your business unless you actually have something to measure. This is the importance of having a good accounting firm working with you, and that the measurements are accurate. Now, each and every one of you has a chart of accounts, and what we like to do so that we can have good measurements for our clients is when we bring on a new client, even if we're already working with this brand, we want to know specifically where certain transactions go in the financial statements so that we can get the proper measurements. And it kind of alludes to that here. There's two pieces to sales, right? We want to know, hey, is sales growing? Yes, but what is our net doing as well? Your net income should not be going down if your sales are increasing, unless there's some acquisition or some growth measurement or some increase in advertising spending associated with that additional revenue growth. But overall, we like to see our sales and our net income move in conjunction with that growth. So, for example, sales goes up 10%. Let's see if net income goes up 10%. Why? For example, in marketing, John was talking about it previously. What's important about marketing? We want to know for every dollar we spend, how much revenue is it driving? That has to be accurately recorded again so you can measure it correctly. And at the bottom of the slide, you'll see what is good growth, 5%, 10%, 50%. It really depends. Depends on industry, territory, external factors. Last year, 2020 and continue into 2021, depending on the state you're in, those external factors you almost have no control over. We have clients that are in certain, we just call them lockdown states for better or worse, that are having a real tough time right now. We have clients who are in other states where they're not locked down, their business is flourishing. Some of our clients, even in the states where they're not locked down, the type of industry they're in is being impacted. So as an example, we have a client who's in the swimming pool industry. His business is doing very well. Why? Because people were locked down. They wanted to get their pool and everything running appropriately, make that renovation because there was an initial assumption that we may never get out of our house. So I'm going to be spending a lot of time here. I need to get my pool fixed. It's helping his business. There are other clients who, they're in the food space. So obviously that's been impacted tremendously and in a negative way, in any state that you're operating in. So growth is dependent on those things, the industry, the territory, the external factors, etc. A good thing with measuring success is you don't consider profitability alone. Other factors are important to consider as you grow. This is another important thing for our clients, is the cash position. Do you have enough cash to sustain operations? This is going to be, again, dependent on the type of industry you're in or the brand you're choosing. For example, if you're choosing a very capital intensive brand, let's say you're a landscaping company of some sort. Well, you've got trucks, you've got trailers, you've got equipment, you've got a lot of employees. So cash flow is very important to you. Debt. If you're burdened with debt and you're not treating debt the right way, again, the servicing of the debt is going to kill your cash position. And then receivables. So cash flow is critically important. We have clients that are in certain spaces where they get paid in 30, 45, and 60 days because they're billing insurance companies or they have governmental contracts. It's imperative for them to understand how to manage their receivables so they can collect as soon as possible. So as an example, if you don't submit some invoice appropriately to the right person and all your I's are dotted and your T's are crossed, then it may take an additional 20 to 30 days to get paid. So your terms went from 30 days. Now you're getting paid in actually 50 days. This is critical for clients who have receivables to understand receivables and the collection of those receivables, because it's going to be it's going to go, well, if I have debt, will I be able to service my debt effectively? Will I be able to pay my guys effectively? My cash position, hey, my cash position is turned from a cash turn of 60 days now to a cash turn of 30 days. So the effective cost of the money will actually be reduced.
Jason, hey,
Very
I
important.
just want to add there. This is a client story on receivables. So if you're using QuickBooks Online, which is 99.99% of our clients, they pretty much have a hold on the franchise industry. QuickBooks will say, it also depends on the POS that you're using, the point of sale or the CRM, depending on how your sales are being moved from the point of sale to QuickBooks. QuickBooks can say that you've been paid, and you look at and QuickBooks and say, hey, I'm getting paid, this is great. But you haven't. So if you collect checks, and then you look at QuickBooks and say that, and it says that you've been paid, that doesn't mean the check has been deposited. So I've actually seen situations where the client believes they're being paid, but they're not depositing the checks. And so not only is it important to keep an eye on the age of the receivables, but to reconcile your receivables to your point of sale, because sometimes technology can fail us and we think it's doing everything for us and it's really not. So just on this same vein, you want to have a really good control over your receivables and ultimately your cash.
Thanks, John.
Yep.
Oh, okay. All right. This is an important one as well. This goes back to marketing, and it also goes back to measurement. This is the cost to acquire a customer. So how much are you spending to get each paying customer? That's an important thing to think about. The figure is key to knowing your marketing strategy is working. So as our example here, spending $100 to acquire customers paying an average of 110 one time, that's not a very good number. Your business is going to be dying. You're going to have cash flow issues. You're going to have revenue issues. There's going to be a lot going on there. Whereas spending $5 to acquire customers paying 50 with the opportunity for recurring sales, that's more like it. So here's our example. In 2020, you spent 10% of your $250,000 revenue, 25,000, to acquire 1,000 new customers. Your cost to acquire a customer would be $25 in this case. Now, this is a simplistic example, but part of some of the services we offer at the CFO level is actually tracking this and understanding how your revenue spend is acquiring, how much is that contributing to the cost to acquire a customer. So and what's important as a franchise owner, because you're spending so much on marketing, and yes, they have programs and they've got a philosophy at the franchisor level that you should follow, but if you know that, hey, Facebook right now is really working well for us, well, you can divert some of the resources, your ad dollars, from, let's just say, anything else, a pay-per-click of some sort, and then move it into Facebook. So now if you're actually tracking this the right way, pardon me, and you're understanding your cost to acquire a customer is accurate and measured appropriately, then for every ad dollar you spend, you're utilizing it in the most profitable and effective way. Facebook could be hot for a little bit, then it may move over to LinkedIn. Then it could be pay-per-click. It could be a specific type of pay-per-click. It could be Home Advisor. It could be direct mail. Whatever it is, you need to constantly record and measure these things, and the franchisors are usually pretty good about helping you with this. But if you know you've got $6,000 a month you're spending, why not spend it on the highest return items as they are occurring? Rather than, hey, I got my $500 in Google and that's what we got for Google. Well, if Google's not bringing in any clients that are paying, then what's the purpose of putting the $500 there? Whereas if direct mail is where you're hot, and we have clients, again, this goes back to your territory that you're operating in. There can be cultural concerns. For example, if you're very rural, mailers may work good. If you're in an urban area, there may be better things, flyers or something. My point being is this, is that if Google's not working or these other things aren't working and direct mail is working, why not put that $6,000 or a portion of that $6,000 into direct mailing? And then if you're measuring appropriately, it can jump back to Facebook. Okay, well, direct mailing is not working this quarter. Let's move over to Facebook. I think that's really important for all franchisees. Again, do you have the time to do this? This goes back to what John was saying earlier in the presentation. Who are you working with that can help you with this? Is the franchisor providing those resources to you? If they are, leverage it. If they're not, then who's going to help you with that? Is it going to be some marketing firm? Is it going to be CFO level services that can do the analysis for you? You need to go ahead and identify what is available to you and how you can leverage that. All right, knowing when it's time for debt funding. This is important as well. Sometimes you will need to lean on debt funding for your business. I don't know. We work with a lot of clients who go through the SBA and they get $150,000 plus loans. The debt is good for their business. The objective of it is obviously get the business up and running, get it funded so we can start driving revenue and service the debt, pay down the debt as quickly as possible so that we could potentially get another loan and replicate the territory 1 with territory 2 or new location 2 or new location 3. I think that's critically important. The examples of good debt, this is important. Government guaranteed loans such as an SBA loan, bank lines of credit. We have clients who've used HELOCs on their homes, etc. They're in a weird way. You know, you can leverage your home. Some people do it, but that's again got its own risks associated with it. Now let's talk about the examples of bad debt: high interest credit cards, merchant cash advances. We have clients right now that are used MCAs. They expanded very quickly. They had receivables with which they could leverage, and they have used them effectively. I have a lot of history with asset-based lending, specifically receivables and MCAs. They can be helpful, but they can create a vicious cycle of staying in that MCA funding cyclone, and you're effectively paying, depending on when you pay back this MCA, you can be effective, your effective interest could be upwards of 50 and 60%. So understanding debt, how to acquire it, how to leverage it, and then how to manage the payment back of that debt is going to be critically important.
Yeah. Hey, Jason, could you go back to that slide? I just want to add one thing, and this is another a client story. So, timing when it comes to debt, as Jason was saying, the startup debt, the SBA loan, that's great. But what happens if in operating you need to acquire additional funds? So we work with a client that is a seasonal business, and so we came to find out that had the client went and looked for debt and to acquire debt in November, before they thought they might need it, but they didn't really want to add to their debt, they would have been able to get an additional good debt. They would have been able to get a working capital SBA loan in addition to help them to fund the business. When they eventually decided that, oh my God, I need this now, which was in February, the winter had hit, and now they weren't able to get that good debt because they go off of your recent financial performance. So don't wait. If you even have an inkling, or if you're like Jason was saying, if you're working with a professional who is helping you to time things, you want to, if you even think you might need good debt, you want to go ahead and look into acquiring that as quickly as possible, not wait until things begin to slow and cash gets especially tight, because then you can be forced to go for the merchant cash advance. Jason said, very, very high effective rate of interest on those. So.
Yes, that's actually a very good point, John. And again, what does it go back to? It's understanding and measuring your cash flow so that you can make
Right.
that assessment. So it's critically important, like you said, to know ahead of time when your cash flow is tight and how to address it. Thank you, John. All right, common pitfalls. Okay, these are important. So after working with over 1,000 franchisees across 50 plus brands, these are the common recurring mistakes that are extremely costly, and they do stunt growth and failure. Trying to do everything yourself, not willing to pay professionals for help. Penny smart, dollar foolish, dollar not smart. That is a big one. I'm working with clients right now who said, I can handle the bookkeeping, I can do this, and then they come to us at the end of the year and there's nothing accurate or correct about the books, and the books actually need a cleanup. Well, the cleanup is a long process because we're essentially rebuilding the books. And it doesn't, if you need a cleanup and it's a cleanup that we're going to have to do for you, then you've been operating previously under numbers and making assumptions that are based on wrong numbers. So again, this goes back to what we kind of reiterate over and over and over again: measurement, measurement, measurement. If your numbers aren't right, what's the old saying? Garbage in, garbage out. So that's what you get. Overspending where unnecessary. Okay, I want to tell you this. I have a lot of clients right now who they love to eat out on the road and they spend a lot of money. And if you're doing great, that's great. If you're a startup and every dollar counts and working capital counts, then, what are you spending your money on and why? And you have to take ownership and responsibility of those things as you're a startup, as you're growing, and as you continue to grow. Waiting too long to hire talent. This is a big issue, and every business goes through this, and it's a normal growing pain. But waiting to hire, in our business, if you wait till tax season to try and find a tax manager, well, then you're already behind the eight ball. And we've seen this in some of our clients. They insist on doing installations of certain things. Well, granted, you need to understand how to do the install and you need to have some experience in it. But the sooner that you can hire someone who can do the install for you, do a really good job, and you structure their compensation in a way that they receive, you know, bonuses or higher levels of compensation based on performance, and that gives you time to do what? Go close deals. And we always use this whenever I hear a client say to me, well, I'm going to do the books or I'm going to do the installs. I say, well, how long are you working on the books in a month? Oh, I spend 40 hours a week, or excuse me, 40 hours a month on books and installs. All right. How many appointments could you go to in the 40 hours? Oh, I could go to 20. And of those 20, how many do you close? I usually close about 20%. Okay, so you can close 4 deals. What's the average deal? My average deal is $3,000. So you're telling me, and then it always comes back to this, you're telling me that so you can do books, you're doing them incorrectly, and you can do installs, but you could have someone do it for you. You're going to forego up to 12,000 additional dollars of revenue each month. And when you break it down for people like that, you put them in a position. It's important for you to all understand that this, if you don't, of where's my time most effective. And this is a lot of times people who come from the W-2 world, they don't have to make those decisions because there's a structure around them already. But understanding when it's time is important. Non-compliance, we talked about compliance previously. It's important to stay in compliance so your business can operate. A lack of understanding of how business is important. Again, it goes back to the measurement we talk about. Oh, so here's what we do. Here's how we help franchises. So if you're thinking of buying a franchise or open up a franchise, or you already own a franchise, we can help you establish your business so that you can obtain SBA funding or open your doors, whatever way you capitalize your business. What we do for recurring, we do like it says here, performance of measurement, which is accounting automation, strategical financial discussions, monthly or weekly. We do payroll and reporting automation. We calculate the cost and timing of hiring. We can do the cost to acquire customer calculation, total compliance management, your taxes, your debt timing, tax planning, which is a big piece of what we do for our clients, pay as little taxes as possible from a legal standpoint. And here's how to reach us. You can go to myfranchisecpas.com. That's probably the best way to do it. Go to the appointments link, click on that. You can email us. You can find us on Facebook, Instagram, and you can check out any of our previous and upcoming webinars on our YouTube page. And on our YouTube page, you can also find a way to connect with us. All right, here's our webinar schedule. April 14th through 16th, we're going to be doing tax planning. May 5th, we're going to be doing no cash, no problem. And then on June 6th through the 18th, to buy or not to buy, a CPA's perspective on franchising.
Yeah, I just want to say, yeah, it's sorry, I could have written that a little bit better. 4/16 is the April one, 5/21 is the May webinar, and June 18th is the June. So it's always the third Friday of every month at this time at 11 a.m.
Very good.
Just to clarify.
All right, any questions? Well, we got some right here on the panelists. Will you be able to provide this presentation in PDF or PPT file format, John?
Yeah, so we don't actually share the PowerPoint. We do share the YouTube link. We're going to be sending that out to everybody on our email list. So you'll be able to watch and rewind and go over this webinar again and again as much as you would like.
And Sean said, what is considered minimal? Sean, what does that mean, minimal?
Yeah, I'm sorry, Sean. I just to clarify that question, if you could. And while you're working on that, James, are you providing an advice on cryptocurrencies for use in the business? So no, we don't work with currently clients that have cryptocurrency or want to use it in business. Very new, very up and coming. That's probably going to be a mainstream thing here within the next year or so in business. And you know, as you might be aware, like Elon Musk is big about it. A lot of the bigger the investment companies are starting to put a holding on it.
Well, there's a thing here too, right? That you know, what do you want to use it? What do you want to use this for? So if you have idle cash and it's sitting there, can you invest it in Bitcoin? Sure. Can clients pay you in Bitcoin? I'm sure they can. Is that something you want to do? It's risky. It's volatile. It seems, you know, it's very, very attractive because of the gains. But again, those are things that you just kind of, you know, I like John said, I'm assuming here very soon there will be plenty of ways to pay with just about any cryptocurrency you want.
Yep, and there are definitely there are tax implications to crypto. They added you may have seen if you've already filed your 2020 returns, they asked the question, do you or have you during the year sold, transferred, looked at the wrong way crypto? And if the answer is yes, then you know they want to know more. So if you're buying and working with crypto, the best thing you can do is track everything that you're doing. Track every purchase, sale, movement. For, you know, if you have like your Bitcoin or something on Cash App, on Coinbase. If you have a ledger, you might have like the Nano S. Make sure you're tracking all of that. If we work with a client with, you know, I personally I'm investing in crypto, so I'm you know pretty good at tracking that. So we definitely can help you to have a system down. But just I'd keep at least an Excel sheet with the date and time and amount every time that you move your crypto. If that helps. Balance of salary versus equity. Do you, so James asks, do you have any guidelines to help balance the salary versus equity measurements? That's a really good question. So not necessarily a cheat sheet. I mean, when we work with our clients, we keep an eye on that. Your QuickBooks should be accurate at all times. Like, you should be able to go into your QuickBooks at any moment and know exactly what your equity position is. So if you see your equity is coming at or near zero at a given month, or wait until you close your books for the previous month before you take a draw, then you'll be able to see, okay, hey, let's say, you know, we're coming up to the end of March. So hopefully, depending on who you're working with, your March book should be done by like April the 5th at the latest. So April 5th, you sit down with your CPA or accountant, or if you're doing it yourself, you open up your QuickBooks, you go to your balance sheet, you drop down to the equity section, and you say, hey, at the end of March, I had $5,000 left over in equity. You would be able to take up to $5,000. If you exceed that, you run the risk of at the end of the year, if you have a trend of doing that, you know, you run the risk of being in the situation that I mentioned, where you could actually owe additional taxes because you overdrew. So you're very welcome, James. Okay, we got a minute here or so. Does anybody else have any questions? And again, just as a final note, we're doing this for you guys. Like, we want to make sure that the content that we provide, the webinars, you know, as well as like our blog posts. I don't know if any of you hop onto the website. We at least do a couple a month. We want the content to be driven by what you're looking for. So hopefully we hit some of the points. I mean, what we went over today, again, is what we've heard our clients kind of, you know, struggle with, and as they get into the swing of things of owning a franchise. So looks like we have some questions in the Q&A box. Sorry about that. Rick, yes, we absolutely will. We'll make sure that everybody who signed up today will be added to our email list. So we always send out a reminder at least a week before, but typically about a couple of weeks before the webinar. Again, it's the third Friday of every month. I mean, if you have an Outlook calendar, you might just want to lock in that time, so you'll always get a reminder. But if not, you know, we'll send you our fun, spammy kind of messages and remind you there. So thank you for asking, Rick, and thank you for being here today. Sean asks, what is the minimal amount of pay you can give yourself? So you could pay yourself nothing if you're an LLC. I mean, you don't actually have to draw any money. You could leave all your money inside the business and let it grow. You should draw what you need to survive. So have a really good understanding. This is something that I should have mentioned. This would have been, I'm so glad you asked this, Sean, because this would have been a really good thing to cover in the webinar. Yeah, you want to understand the business you're opening and the cash needs of the business. You want to have a really good handle on your personal financial needs as well. So if you need $2,000 a month, no matter what, to meet the bills, or $3,000 or $4,000, then you can't go below that, right? Like you want to take out at least that. When you might have been referring to what is the minimum you can take on like an S Corp, that comes down to, it's called a reasonable comp. So we use a tool that we pay a pretty expensive subscription for, where we can put in your metrics and figure out, you know, in your state and your industry and with the work that you're doing, what is the minimum, and then you can pay yourself that. So that's good to know if you're an S Corp, and you don't necessarily have like a personal financial need. If you have like a nest egg that you're pulling from, and you don't necessarily need to pull anything from the business. Really good question there. Okay, so Clayton asks a couple questions here. The first one is, when you're searching for talent, how to pay them before you have a job for them. I could use a little bit of clarity on that, but you might be asking like, how do you determine what they should be paid? And you want to pay a competitive market rate. So that's, again, it's really going to depend on the industry you're in, the location, and sometimes, especially if you're in a competitive market for employment, like let's say you're a lawn care business and there's 5 other big competitors in the area and you're coming in, you want to learn what the market rate is in your case. And sometimes you pay them that or a little bit more. And sometimes you want to provide them an incentive when you can, like a profit sharing, a 401k. This is really expensive, but down the line, you might offer them like health insurance. And so, yeah, it's really, you are fighting against your competitors for the best talent. So, when we work with our clients, we help them to determine like what they can handle from a cash flow standpoint, and then you just want to maybe go a little bit above that to meet or exceed what your competitors are doing. And then your second question here, to measure success, what type of banks to use for the business? That's a really interesting question. I've heard a lot of good things, and I'm familiar, see a lot of good things with credit unions if they're available. What you run into with credit unions and some of the co-op and the smaller banks is they might not have as good of a like a GUI, like an interface when it comes to seeing your data from your bank. How you want to see how long they're keeping your information. Like I know that PNC, which is a bigger bank, but they only, it's like, I want to say 12 months. You can only see your bank statements for up to 12 months. Sorry if that's an inaccurate quote. It might be 18, but it's pretty short. And then if you need to go beyond that for whatever reason, you have to actually pay for statements. So stuff like that. And then you want a bank that can actually connect to your QuickBooks, which by this point is all of the big ones and even a lot of the credit unions. So there's a couple things to consider there. It's always a good, of course, you want the bank to be FDIC insured, which most, if not all are. And then if there's any benefits, if you get like a sign on with your business, get $300 or anything like that, it's always a good plus. Really good questions there. Rick said, great webinar. Thank you, Rick. Really appreciate that. Sean said, S Corp LLC. Okay, so I think I clarified that, right? The LLC, you can pay yourself nothing. S Corp, you have to at least pay yourself a reasonable comp and of a salary. Clayton said, it's more about timing of hiring, getting your first job. I'm in the contracting business. Clayton, it seems like a more of a specific question. I know you had another question for us offline. So I'm going to go ahead and send you a link to set up a call. And please remember that question and write it down, because I do want to make sure that we go over anything that you are curious about. Okay. All right, good deal. So thank you all also so much for coming. We look forward, hope to see you in our next webinar, which again will be on the 16th of April at 11 o'clock Eastern. Thanks so much. Take care now.
Bye, y'all. Thanks.